Hello, welcome to the European Open briefing for Wednesday, January the 10th. I'm Rafi Borajan, currency analyst at XM.com, and we're going to be taking a look at the latest developments in the currency markets today. So most major pairs are relatively steady this morning, though the dollar continues to slide against the Japanese yen. The yen continues to rise on the back of speculation that the Bank of Japan may be getting ready to trim back its asset purchase program following its slight reduction in its regular market operations in buying long-dated Japanese government bonds. And in commodities, we're seeing oil prices continue to set fresh highs. WTI crude hit a 3-year high this morning on the back of declining US inventory. So let's start with the what's happening with the dollar yen. We can see here in orange, it's been falling for the past 2-3 days, though we do have some attempts upwards in between that downslide. In purple, we can see the yield on 10-year US Treasury notes. So it's a rather strange picture because normally when US yields go up, the dollar goes up as well. And we're seeing the 10-year yields hitting a 9-month high of 2.573% this morning in Asian trading, but that hasn't really done much to help dollar yen. And the reason why dollar yen is falling is because the yen is outperforming all other major currencies on expectations that speculation rather that the Bank of Japan might be signaling to the markets that it wants to start paring back its huge asset purchase program. The dollar yen hit a 1-month low of 111.75. The dollar index is doing slightly better, mainly due to continued euro weakness. But overall dollar index is also looking bearish. It's not too far from September's 2.5-year lows. So the bond yields, global bond yields, have been given a huge boost from what happened yesterday when the Bank of Japan reduced slightly its purchases of long-dated Japanese government bonds. In particular, the 10-year yields have risen to 9-year highs, and that's probably just serving as a reminder to investors that in 2018-2019, we're going to see further tightening of monetary policy around the world. The Bank of Japan is the last of the major central banks to start scaling back its asset purchase program. The ECB has already it's halved its asset purchases. The Bank of England and the Bank of Canada have already started raising rates. So if the Bank of Japan starts doing that as well, so that will mean an end to the era of ultra-loose monetary policy. Moving to other yen crosses, we can see here the euro and the pound both have fallen to 3-week lows. Although despite this big moves in the past day or so, many analysts see this as an overreaction, as the Bank of Japan has repeatedly reiterated its pledge to maintain current loose policy until inflation reaches its 2% target, and it's currently a long way off. Core inflation is currently 0.8% in Japan, so there's still some way to go. Although if the Bank of Japan was to make a move, it would likely be cutting back on its ETF purchases due to the fact that the Japanese stock market is currently booming, so the purchase of ETFs could be causing a disruption in stock prices. So that could come within the next few months. The Bank of Japan's next meeting is on January 22nd, 23rd. So we're going to have to wait and see whether they're going to signal anything at that meeting. Moving now on to European currencies, the euro and the pound against the dollar. Euro dollar is stuck near yesterday's lows. It fell below the 1.20 handle, mainly on the back of profit taking. The euro had rallied strongly in mid to late December, surging to 4-month high 1.2089. We did have very strong data this week, in the form of Eurozone business surveys and strong German industrial output and trade numbers yesterday, but that really didn't do much for the euro. The pound, on the other hand, has not been doing too badly against the dollar, despite the fact that the cabinet reshuffle by the Prime Minister Theresa May didn't go down quite as well as she'd been hoping, and there was doubts as to whether it did anything to assert authority in the Conservative Party, and whether or not it really it's going to have a positive impact. But we're seeing the pound dollar well supported above the 1.35 level, and it did get a bit of a boost this morning from better than expected UK industrial output and manufacturing data. Let's take a look at the yuan now, because the People's Bank of China did change the way it calculates the midpoint for fixing the yuan's midpoint. That actually took place at the beginning of the year, but it's only just come to the surface. Its changes. It's basically removed the counter-cyclical factor in its calculations, and that explains why the yuan has been falling sharply this week. In particular, yesterday, it did. We saw the dollar yuan rising above the 6.50 level, so that could spell further weakness for the yuan in the short term, although we can see in the long-term trend for the yuan is up. We can see the dollar has been declining against the yuan since early 2017. We also had Chinese producer price data out this morning. They rose by 4.9% year on year in December. This was slightly above forecast of 4.8%, but down from 5.8% in November. The main reason for the fall is the fact that the Chinese government is taking tougher measures on clamping down on polluting industries. This is hurting production, and which is in turn affecting demand for some raw materials. Although the fact that production is down in many industries, it is leading to some supply shortages for, say, products such as steel, and that in turn, and also iron ore as well. So that's also creating some upside price pressures on those particular raw materials, which is helping the Australian dollar. We can see the Aussie is up this morning, up 0.5% against the US dollar, currently trading around 0.7835. Sorry, up 0.15%. The Kiwi is up 0.5% against the dollar. In fact, the Kiwi is at a 3-month high. It briefly topped the 0.72 levels for the first time since October. And the main driver of commodity prices this morning is oil. We can see WTI crude is currently trading at 3 months. At a 3-year high. Yesterday we had the API inventory report, which showed a much bigger than expected drop in US oil inventories. That drove WTI prices to $63.57 a barrel. We're going to have the EIA report later today. We did also have some forecasts from the EIA. They predict US output to hit 11 million by late 2019. However, they are also expecting demand to rise by more than expected. So that is probably only reinforcing expectations that together with the OPEC output cuts, the oil market will tighten further this year. And finally, let's take a look at today's economic calendar. We can see the UK data there, which came in slightly better than expected. Monthly growth of 0.4% for both industrial and manufacturing output versus forecast of 0.3%. Though we did see an upward revision to the prior month. However, the trade balance came in worse than expected. It's going to be slightly quieter in the US section. We're going to have Canadian building permits and wholesale inventories. That's it from me. Thank you very much for watching, and have a great day.